What if I told you that 10 billionaires turned America's playground into a corporate wasteland where a beer costs $20, source parking runs $40, and the dealers are being replaced by iPads? The Las Vegas Strip wasn't killed by bad luck or changing times. It was systematically gutted by a handful of ultra-wealthy owners who saw your memories as line items on a spreadsheet. While tourists keep flooding in, they're walking into a trap engineered by Wall Street titans who've turned Sin City into the world's most expensive disappointment. Today, we're revealing the billionaires who destroyed everything that made Vegas magical. Number 10. Phil Ruffin, the cost-cutter king meat. Phil Ruffin, the 89-year-old billionaire who turned Vegas icons into profit machines by stripping away everything that made them special. When Ruffin bought Treasure Island from MGM for $775 million in 2009, locals hoped this self-made Texan would restore the pirate-themed Wonderland to its former glory. Instead, he immediately killed the free pirate show that had entertained millions for 16 years. Why? The actors and technicians cost too much. At Treasure Island today, you'll find $25 minimum blackjack tables with 6 Palm being 65 payouts, rooms that haven't been renovated since 2008, and a pool that charges $40 just to lay on a chair. The mystique is gone, replaced by naked profit extraction. Then there's Circus, which Ruffin snatched up for $825 million in 2019. This property once symbolized family fun with free circus acts and affordable entertainment. Under Ruffin's ownership, maintenance requests pile up, reviews plummet, and the circus acts run on skeleton crews. The numbers tell the story. Ruffin's net worth has swelled to $3.5 billion, while his properties consistently rank among the worst on the Strip. TripAdvisor reviews for Circus average 2.5 stars, with guests describing broken elevators, stained carpets, and a pervasive smell of decay. Yet Ruffin keeps collecting $300 million in annual revenue from these deteriorating properties. Here's the tragedy. Ruffin knows exactly what he's doing. He once told Forbes, "I don't need the newest or the best, I need profitable." That philosophy might work for parking lots or strip malls, but when applied to Vegas landmarks, it crushes the very spirit that built this city. Every corner cut, every show canceled, every renovation delayed is another nail in the coffin of old Vegas magic. And while Ruffin counts his billions, families arrive expecting wonder and find a hollowed-out shell charging premium prices for discount experiences. But if you think turning Vegas cheap is bad, wait until you see how the next billionaire transformed it into something even worse: boring. Number 9. Sheldon Adelson, the convention overload. Before Sheldon Adelson died in 2021, he fundamentally rewired Las Vegas's DNA, transforming it from an entertainment mecca into a corporate conference center. His $1.5 billion Venetian, opened in 1999, wasn't built for tourists seeking thrills. It was engineered for convention attendees with expense accounts, and that single decision changed everything. Adelson didn't just build a casino, he built the Sands Expo and Convention Center, adding 2.25 million square feet of meeting space to the Strip. Suddenly, Vegas wasn't competing with Atlantic City for gamblers. It was competing with Chicago and Orlando for trade shows. The numbers looked brilliant on paper. Convention attendees spend 3 times more than leisure tourists, dropping an average of $200 per trip versus $400 for regular visitors. But here's what Adelson's spreadsheet missed. Conventions killed Vegas's soul. Walk through the Venetian on any Tuesday afternoon. You'll see thousands of badge-wearing professionals checking phones, attending mandatory dinners, and treating the casino floor like a hotel lobby. These aren't dreamers chasing fortune. They're employees watching the clock. The transformation spread like a virus. Once competitors saw Adelson pulling in $3 billion annually from conventions, everyone wanted in. Wynn added convention space. MGM expanded theirs. Even Caesars jumped aboard. Today, Las Vegas hosts over 22,000 conventions annually, clogging the Strip with rental cars, turning restaurants into networking events, and pushing room rates through the roof during major shows. A room that costs $89 on a random weekend suddenly jumps to $400 when a tech conference rolls into town. Adelson's vision succeeded financially. Las Vegas Sands became the world's largest casino company, worth $48 billion at its peak. But success came at a price. The entertainment that defined Vegas got pushed to the margins. Afternoon shows disappeared. Lounge acts vanished. Free attractions closed. Everything catered to the business crowd willing to pay $60 for breakfast, because American Express was covering it. The irony is thick. Adelson spent his final years as the richest person in Nevada, worth $35 billion, having built an empire by making Vegas less fun. He turned the world's adult playground into the world's most expensive office park. And speaking of expensive transformations that went wrong, that brings us to the man who once represented Vegas luxury at its finest, before his spectacular fall opened the floodgates for something far worse. Number 8. Steve Wynn, the fallen visionary. Steve Wynn was different. While other owners saw casinos as cash machines, Wynn saw canvases for billion-dollar art projects. The Mirage's volcano, Bellagio's fountains, Wynn's mountain waterfall. These weren't just attractions, they were statements that Vegas could be both profitable and magical. For 3 decades, Wynn protected the Strip from becoming a corporate wasteland. Then, in 2018, everything collapsed. The misconduct allegations against Wynn did more than topple a man. They destroyed the last barrier between Vegas and complete corporate takeover. When Wynn was forced to sell his 11.8% stake in Wynn Resorts for $2.1 billion and flee to Florida, he left behind a power vacuum that Wall Street rushed to fill. Consider what Wynn properties meant before his fall. The Bellagio hosted actual art galleries with Picassos and Monets. The restaurants earned Michelin stars. The shows pushed creative boundaries. Wynn spent $2.7 billion building his namesake resort, including $500 million just on the art collection. That's not rational corporate behavior. That's obsession with excellence. Now look at those same properties. The art, increasingly locked away for private events. The shows, replaced by DJ residencies that require less overhead. The service standards, crumbling as corporate managers prioritize efficiency over excellence. Without Wynn's iron grip on quality, his properties became just another portfolio for shareholders to optimize. The timing couldn't have been worse. Wynn's exit in 2018 coincided with private equity's aggressive push into Vegas. These firms saw Wynn's fall as their opportunity. If the king of Vegas luxury could be dethroned overnight, why not buy up everything and run it like a suburban shopping mall? Here's the bitter truth. Wynn was a problematic genius who did terrible things, but he was also the last mogul who genuinely cared if the volcano looked perfect or if the flowers in the lobby were fresh. His $3.2 billion fortune came from understanding that Vegas needed to sell dreams, not just hotel rooms. Today, Wynn lives in exile while his former empire gets carved up by MBAs who think a casino is just real estate with slot machines. The man who insisted on Italian marble and fresh orchids has been replaced by executives who calculate the profit margin on every cocktail napkin. And that systematic corporatization was about to accelerate dramatically under our next billionaire, who turned consolidation into an art form. Number 7. Jim Murren, the MGM consolidator. Jim Murren didn't just run MGM Resorts from 2008 to 2020. He weaponized it, turning a casino company into a monopolistic machine that swallowed half the Las Vegas Strip. Under his watch, MGM Properties grew to control 18,000 of the Strip's 30,000 hotel rooms. That's not competition, that's domination. And with that domination came the death of everything that made each casino unique. Remember when Mandalay Bay felt tropical, New York felt energetic, and the Mirage felt mysterious? Murren ended that. He pioneered the One MGM strategy, standardizing everything from cocktail recipes to carpet patterns across properties. Why maintain different identities when you can slash costs by bulk ordering everything? The same slot machines, same restaurants, same corporate blandness everywhere. But Murren's true innovation was more sinister. Dynamic pricing. MGM became the first to use airline-style algorithms that changed room rates hourly based on demand. That $89 room you saw online, by the time you clicked book, it jumped to $120 weekend poolside cabanas that cost $500 in 2010, now hit $2,000 during fight weekends. Even parking, free for 50 years, suddenly cost $25 daily after Murren decided in 2016 that leaving your car was a profit opportunity. Then came resort fees, Murren's most hated legacy. These mandatory charges, reaching $45 nightly by 2019, covered amenities like gym access and Wi-Fi that were previously free. The Federal Trade Commission called them deceptive. Murren called them necessary for reinvestment. That reinvestment? His personal compensation hit $37 million in 2019, while service quality plummeted and thousands of employees got laid off. The numbers exposed the scam. MGM's revenue jumped from $7.2 billion to $12.9 billion under Murren, but customer satisfaction scores dropped 23%. TripAdvisor reviews increasingly mentioned nickel and diming, corporate greed, and lost Vegas charm. Murren turned MGM into a $14 billion empire by treating customers like cattle to be processed, not guests to be entertained. When Murren finally left in 2020 with his $32 million exit package, he left behind a strip where half the casinos operated like airport terminals, efficient, expensive, and utterly soulless. His philosophy spread industry-wide as competitors copied his tactics to keep up. But while Murren was destroying tourist Vegas, another billionaire was quietly doing the same thing to the locals who built this city. Number 6. Frank Fertitta III, the local-turned-corporate shark. Frank Fertitta III was supposed to be different. Born in Vegas, raised in Vegas, his family name literally carved into Vegas history. His father started Station Casinos in 1976 to serve locals who wanted to gamble without strip prices. For decades, Station Casinos meant community, cheap buffets, generous video poker odds, and properties where dealers knew your name. Then Frank took over, and loyalty became liability. The transformation started after Fertitta and his brother bought Station Casinos private in 2007 for $8.5 billion. When the recession hit, they filed bankruptcy, wiped out $6 billion in debt, and emerged owning 100% of a cleaned company. Investors lost everything. The Fertitta kept their empire. That's when locals learned that being Vegas-born doesn't mean you care about Vegas people. Post-bankruptcy Station Casinos became unrecognizable. The beloved $4.99 steak special at Palace Station? Gone. The generous slot club rewards that kept retirees coming back? Slashed by 40%. The free play offers that made locals feel valued? Replaced by tier-based incentives, requiring thousands in losses to earn a free buffet. Even employee benefits got butchered, with health insurance costs doubling while wages stayed frozen. The numbers tell a story of betrayal. Between 2011 and 2019, Station Casinos' profits rose 67%, while their customer loyalty scores dropped to the lowest in company history. Red Rock Casino, once the crown jewel for upscale locals, now charges $30 valet parking and $18 cocktails to people who live 5 miles away. Green Valley Ranch, beloved for its resort-style pool, now demands $40 weekend entry from Henderson residents. Here's what stings most. Fertitta used his local credibility as cover for exploitation. He pushed anti-union campaigns while paying himself $290 million in dividends. He lobbied against neighborhood casino competition while opening new properties in working-class areas, knowing residents had nowhere else to go. The company that once sponsored Little League teams now squeezes every penny from the communities that supported them through 3 generations. Frank Fertitta III. Third proved something devastating. Even homegrown billionaires will sacrifice their neighbors for profit. His net worth hit $2.6 billion by treating lifelong customers like tourist marks. The man who should have protected local Vegas instead showed outside corporations exactly how to exploit it. And speaking of exploitation disguised as luxury, that brings us to his cousin, whose flashier brand of greed operates on an even grander scale. Number 5. Tilman Fertitta, the luxury illusionist. Tilman Fertitta wants you to know he's rich. His reality show was literally called Billion Dollar Buyer. His yacht, the longest in America, costs $250 million. His Golden Nugget casinos plaster his name everywhere like a designer label. But behind the flash, Fertitta represents something insidious. The billionaire who sells you luxury packaging with discount execution. When Fertitta bought the Golden Nugget Las Vegas for $386 million in 2005, he promised to restore downtown's crown jewel. Instead, he turned it into a masterclass in corner cutting. The Shark Tank pool that attracts Instagram tourists, it hasn't been properly renovated in 15 years. The rooms marketed as luxury suites contain furniture from 2008. The restaurants bearing celebrity chef names serve Cisco-grade ingredients at Wagyu prices. His modus operandi never changes. Buy an iconic property, slap on golden paint and his personal brand, jack up prices, then gut quality where cameras don't reach. At Golden Nugget Atlantic City, he eliminated free drinks for video poker players spending hundreds per hour. In Lake Charles, he replaced experienced dealers with fresh graduates, paying them $213 hourly plus tips. Every property gets the same treatment: maximum extraction, minimum investment. The numbers expose the con. Fertitta's Landry's Corporation, which owns Golden Nugget, generates $4.5 billion annually. Yet Golden Nugget Las Vegas maintains a 3.5-star average on Google reviews, with complaints focusing on worn rooms, terrible service, and not worth the price. The disconnect is intentional. Fertitta banks on the Golden Nugget name and flashy marketing to draw first-time visitors who won't return anyway. But Fertitta's real damage goes deeper. By positioning himself as a luxury operator while delivering motel-grade experiences, he's normalized disappointment. Tourists now expect Vegas luxury to mean paying $300 for a dated room with gold-painted fixtures. His success proved to other owners that you don't need to deliver quality if your marketing budget is big enough. This Houston billionaire, worth $8.5 billion, perfectly embodies New Vegas. All sizzle, no steak. Every property he touches becomes a hollow shell, trading on past reputation while delivering modern disappointment. He's turned casino ownership into brand licensing, where the name matters more than the experience. But if you think selling fake luxury is bad, wait until you see what happens when Wall Street stops pretending casinos are anything more than commercial real estate. Number 4. Stephen Schwarzman, the Wall Street landlord. Stephen Schwarzman never wanted to run casinos. The Blackstone CEO, worth $48 billion, wanted something far more profitable: to own them like rental properties. In 2019, his private equity firm bought the real estate of Bellagio, MGM Grand, and Mandalay Bay for $4.2 billion, then immediately rented them back to MGM. With that single deal, Schwarzman transformed Vegas from an entertainment destination into a financial instrument. Here's how the scheme works. Blackstone buys the physical casino buildings, then charges the operators massive rent to use them. MGM now pays Blackstone $292 million yearly just to operate in buildings MGM originally built. That rent payment must be made whether the casino profits or loses, whether a pandemic hits or tourists vanish. It's guaranteed income for Wall Street, guaranteed pressure for operators. This model broke something fundamental about Vegas. Casino owners used to think long-term, investing in properties they'd run for decades. Now they're just tenants trying to make quarterly rent payments to New York landlords. Every dollar spent on renovation, entertainment, or customer service is a dollar not going toward rent. Guess what gets cut first? The financial engineering gets worse. In 2021, Blackstone bought Aria and Vidara for $3.9 billion using the same strategy. Then they grabbed the Cosmopolitan for $5.6 billion. By 2023, Blackstone controlled $40 billion in Vegas real estate, making them the Strip's largest landlord. They don't care if you have fun. They care that rent checks clear. The consequences ripple everywhere. When operators face massive rent obligations, they compensate by raising prices, cutting staff, and eliminating anything that doesn't generate immediate revenue. Free lounges disappear, comped drinks vanish, service quality crumbles. The very things that made Vegas special become unaffordable luxuries when Wall Street demands its cut first. Schwarzman turned Vegas into a real estate investment trust with slot machines. His innovation wasn't building anything or creating experiences. It was recognizing that Vegas properties could be financialized like shopping malls or office buildings. Extract rent, minimize investment, let someone else deal with customers. Pure parasitic capitalism. This Yale-educated financier revolutionized Vegas by never actually operating a casino. He proved ownership matters more than operation, that collecting rent beats creating entertainment. While tourists pay $20 beers and $50 resort fees, Schwarzman collects billions in rent from his Connecticut mansion. He's the invisible hand squeezing every Vegas experience, the landlord you never see who ensures your trip costs more and delivers less. Number 3, James Dolan, the Sphere visionary and distraction. James Dolan spent $2.3 billion building a giant LED ball in the desert, and everyone called him a visionary. The MSG Sphere, opened in 2023, stands 366 feet tall, contains 160,000 speakers, and wraps 580,000 square feet of LED screens around its exterior. It's the most expensive entertainment venue ever built. It's also everything wrong with modern Vegas, a massive, expensive distraction from the city's hollowing core. The Sphere perfectly captures Vegas's new philosophy: spend billions on spectacle while the actual casino experience rots. Dolan, already worth $2 billion from Madison Square Garden operations, convinced Vegas that what tourists really needed wasn't better odds, cheaper rooms, or quality service. They needed to pay $400 to watch U2 inside a giant television. Opening night tickets hit $2,500 on secondary markets. Even nosebleed seats for regular shows start at $195. Here's the real insult. While Dolan's Sphere consumed billions in construction and tax breaks, the casinos around it continued deteriorating. The Venetian, sitting in Sphere's literal shadow, still charges resort fees for amenities that barely function. The Palazzo's rooms haven't seen meaningful renovation since 2007. But hey, at least you can watch a $50 million commercial for Postmates on the Sphere's exterior while you walk past. The economics expose the madness. The Sphere needs to generate $600 million annually just to break even. That means constantly booking acts at prices only the wealthy can afford, further pushing Vegas away from average Americans. Meanwhile, construction debt and operational costs ensure that even if the Sphere succeeds, the profits flow to Wall Street bondholders, not Vegas workers or visitors. Dolan's Sphere isn't just a building, it's a metaphor. Vegas used to be about human experiences, dealers who knew your name, shows you could afford spontaneously, the thrill of possible fortune. Now it's about staring at screens, overwhelming your senses with technology, and paying premium prices for passive consumption. The Sphere represents Vegas's transformation from participatory playground to expensive movie theater. The bitter irony? Tourists post more Instagram photos of the Sphere's exterior than anything inside it. Dolan built a $2.3 billion advertisement for itself, a monument to spectacle without substance. It's Vegas's most honest attraction. Gorgeous from the outside, overpriced inside, and ultimately, just another way to separate you from your money. But while Dolan built his expensive distraction in plain sight, another billionaire worked quietly behind the scenes to transform Vegas entertainment into something even more corporate. Number 2, Barry Diller, the quiet power broker. Barry Diller never built a casino, never owned a hotel, barely visits Vegas. Yet the 82-year-old media mogul, worth $4.8 billion, architected the corporate entertainment takeover that stripped Vegas of its do-tay character. Through IAC's web of media companies and strategic MGM board positions, Diller pushed Vegas toward a model where every show, restaurant, and experience serves corporate synergy instead of customer joy. Diller's influence operates through connection and control. His IAC conglomerate owns Expedia, controlling how millions book Vegas trips. He served on MGM's board during its critical consolidation phase. His media relationships determined which Vegas shows got national coverage. Without owning a single slot machine, Diller shaped how Vegas sells itself to America, and what he sold was corporate uniformity. Consider how Vegas entertainment transformed under Diller's influence. Unique, weird, only in Vegas shows got replaced by touring Broadway productions and celebrity residencies. Why? Because corporate partnerships demand scalable, predictable, cross-marketable content. That quirky magician who performed at Tropicana for 20 years doesn't fit the multimedia strategy. but a Lady Gaga residency that drives Spotify streams, merchandise sales, and HBO specials? That's synergy. The consolidation goes deeper. Diller pushed Vegas toward entertainment monopolies where Live Nation controls concerts, Cirque du Soleil dominates productions, and celebrity chef corporations run restaurants. Independent operators can't compete with these entertainment conglomerates, marketing budgets, and corporate partnerships. The result? Every Vegas venue starts feeling identical, offering the same sanitized, focus-grouped experiences approved by corporate committees. His fingerprints are everywhere. That $30 cocktail priced by algorithm? Diller's data-driven pricing philosophy. The identical restaurant menus across different casinos? His brand standardization strategy? The death of afternoon shows and lounge acts? His profit optimization models proved they weren't efficient revenue generators. Here's what makes Diller so dangerous. He understood that controlling distribution and media matters more than owning properties. Why buy casinos when you can control how they're marketed, who performs there, and what prices customers expect to pay? His IAC empire proved Vegas could be corporatized without touching a single poker chip. Barry Diller transformed Vegas into a subdivision of American corporate entertainment. Under his influence, the city stopped being a unique destination and became just another content delivery platform optimized for maximum extraction. He proved you don't need to own Vegas to control it. You just need to own the systems that feed it. But even Diller's media manipulation pales compared to our final billionaires, the ones who've turned the entire strip into their personal ATM. Number 1. The private equity titans, the true puppeteers, Apollo Global Management, Vici Properties, Blackstone. These aren't household names, but they're the real owners of Las Vegas. Together, these private equity firms control over $60 billion in strip assets. They don't run casinos, they own them like stock portfolios. And that transformation from entertainment destination to financial spreadsheet has finally killed what made Vegas special. Here's their playbook. Buy casino properties using borrowed money. Split the real estate from operations. Rent the buildings back to operators at crushing rates. Extract massive fees. Sell to another fund in 5 years. Repeat. In this model, you're not a guest or even a customer. You're a revenue unit whose lifetime value gets calculated against acquisition costs. Vici Properties, spun from Caesars bankruptcy, now owns Caesars Palace, Harrah's, Venetian, and MGM Grand's real estate. They collect $2.1 billion in annual rent. Apollo Global owns the operations of Venetian and Palazzo through a $6.4 billion deal. Blackstone owns Bellagio, Cosmopolitan, and Arias buildings. Combined, these firms control 75% of strip properties. That's not a market. That's a monopoly run by spreadsheets. The human cost is staggering. When private equity owns your casino, every decision flows through Excel models. A dealer making $15 hourly looks like an expense to minimize. Free drinks become revenue leakage. Renovations get deferred because they hurt quarterly returns. These firms typically hold properties for 5 to 7 years, just long enough to extract value, never long enough to invest in long-term quality. Their innovation? Financial engineering that makes everything worse. They pioneered sale-leasebacks that burden casinos with rent. They created REITs that prioritize shareholders over customers. They invented fee structures that guarantee they profit whether casinos succeed or fail. When COVID hit, these firms still collected rent while workers got fired and services disappeared. The spreadsheet empire manifests everywhere. That $25 minimum blackjack table? Algorithms determined that's optimal revenue per square foot. The $30 parking? Data showed you'll pay it anyway. The disappearing free play and comps? Machine learning proved they weren't generating sufficient ROI. Every degraded experience traces back to a PowerPoint deck in a Manhattan boardroom. These faceless firms achieved what no individual billionaire could. They turned Vegas into pure financial abstraction. Mark Rowan, Apollo's CEO worth $6.5 billion, probably couldn't name a single Vegas dealer. John Gray, Blackstone's president worth $7.2 billion, likely never played a hand of blackjack with regular people. They don't need to. Their Excel models tell them everything. Required to extract maximum profit from your memories. This is how Vegas truly died. Not through one bad owner or single terrible decision, but through systematic financialization by private equity firms that see America's playground as nothing more than a yield-generating asset class.